November now makes 3 of the last 4 months and 4 of the last 6 for negative payrolls. According to ADP, job losses accelerated in November, minus 31,000, so a new low there. And in fact, it turned the 6-month average negative for the first time this cycle, confirming we are seeing serious problems in the labor market that are becoming serious problems in the housing market. According to the latest estimates from the U.S. government, home prices were negative again in September for the 4th time in the past 5 months, which brought the annual rate of change down to its lowest rate since February 2012. Yes, February 2012, the bottom of the last big, huge housing bust. As I've been telling you all year, these two developments are very much related. Home buyers have been increasingly moving to the sidelines over employment fears that are no longer fears, by the way. ADP and other data sources, including the BLS, though the government data is stale at this point, all of it shows multiple months of outright job losses. So no matter what's happening with mortgage rates, people aren't going to be buying houses, and they're not buying houses. At the same time, though, the numbers of those that are for sale, both new and existing, continue to rise, which is why there's been this continued pressure on home prices. But here's the thing. As alarming as these declines in home values already are, there are a number of indicators showing the situation in real estate, like the real economy, is worse than it already appears. For the first time in 50 years, for example, new home prices are actually at a discount to comparable existing houses that are up for sale. First time in 50 years. It was never tariffs and trade wars. So you add more confirmation of job losses, and not only does it risk the housing market becoming unglued at this point, it's more confirmation of the economy that is moving in the wrong direction. It gets more certain, not less certain. It's just that what it gets more certain about is not what everyone was hoping and thinking. But as far as the real estate market is concerned, there is a big difference this time around versus either 2022 or the big bust from a generation ago. In that first one, 20 years ago, out of control mortgage credit created a bubble, which then triggered a monetary crisis that erased credit growth and hampered money circulation, all of which then caused the massive backlash in the economy. In 2022, by contrast, a sudden rise in mortgage rates concurrent with a huge increases in home prices, not to mention the cost of living, those altogether choked off the housing market, but it only led to a short-term correction of sorts. Home prices came down a little, but only for a short while before the property sector stabilized. Never really recovered after that, though. But then you get to hear in 2025, very different story. Now we have these macroeconomic factors that are at the forefront. First of all, fears over jobs and incomes that are canceling out any positive impact from mortgage rates. And now that those fears have been largely confirmed and continuously confirmed, flat beverage isn't the future, it's happening right now. The housing market is suffering for it, and in that way, the downturn in activity and pricing is itself more confirmation of the flat beverage reality. So that brings us to the latest jobs data from ADP. Now, the Research Institute at ADP had been putting out weekly numbers, which you've been following, and so in many ways, the weekly numbers already stole the spotlight from the monthly figure that we just got for November. Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold, and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video. And the full monthly figure came in at minus 31,000. So that makes 3 small negatives out of the last 4 months and 4 of the past 6. And more importantly, as I said in the introduction, the 6-month average also just turned negative for the first time. And the reason that's important is because when you see multi-month averages dip below zero, that tells you the chances of some random fluctuation in the economy or even in the statistics themselves is pretty much zero at this point. If there was a single monthly negative and maybe even two, you might look at that as some kind of one-off or possible anomaly. But when any data series keeps putting up enough negatives and not large enough positives to offset them so that the average, in this case the 6-month average, drops below zero, that's significant confirmation that some level of job shedding is taking place, and moreover, it isn't being confined to a short-run set of unique circumstances. That had been one of the claims, by the way, that a lot of people were making, including the so-called hawks like Casey Jeff at the FOMC. They were wondering if these job losses might have been an aberration or some singular outcome related to non-economic factors like immigration enforcement. Go back to Jay Powell's press conference at the end of October, the one that I did the live video on. The Fed had just voted for a second rate cut in a row, but Casey Jeff had dissented against it. And overall, Powell's tone at the press conference appeared to be quite hawkish. At least that's how he was when he was recounting the split among committee members, and that's certainly how it was sold by the mainstream media. Part of it was due to tariff inflation and this unkillable idea that consumer prices are about to explode higher any minute now, any day. But also those aligned with Casey Jeff and the Fed funds ban weren't really convinced the labor market weakness that the doves at the Fed, led by Waller and Murin, were using to justify the further rate cutting. They weren't convinced the labor market weakness was actually real. If you remember what Powell said, quote, "For some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether, in fact, that the stronger growth that we're seeing is real. The stronger growth, not so much." As far as downside in the labor market, that continues to be confirmed in any number of ways, starting with ADP. As I said, 3 negatives in 4 months, 4 out of the last 6. The 6-month average now below zero. The data says it wasn't a short-run thing at all. The job losses have not only been confirmed as extending into November, they're getting bigger, meaning the trend remains, therefore pointing to that downside case that Casey Jeff tried to write off just a little over a month ago. And let's not forget, there are also multiple negatives in the BLS data. Even though it was only through the month of September, it was the August revision that turned August into the second monthly negative that stole the show and stole the spotlight from the otherwise September headline that seemed to be predictably well above expectations. So even the non-farm payrolls series, which a lot of people still wrongly consider as the true representation of the labor market, even the non-farm payrolls series now shows 2 monthly negatives of its own. And even if the data is old, by validating ADP's summer findings, this also raises the probability that ADP remains on target for the real labor market up to and including November. So job losses are taking shape, and even if they aren't huge right now, it's not the numbers or the size of the monthly minuses, it's how frequent they become, and therefore the trend for overall employment environment. And it all just keeps pointing to some degree of flat beverage, a transition from no hire, no fire to now no hire and some fire. And if it keeps going like Jay Powell admitted, you get to be no hire and quite a lot of firing, maybe a lot faster than people are predicting or people are expecting. And I think it's also worth pointing out, as I did recently, that the rest of the Fed, apart from Casey Jeff and his gang, see this thing very different than they do. The Beige Book for November, for example, barely mentioned inflation at all, just 6 times in the entire edition, lowest in years. At the same time, the number of times the term layoff or layoffs appeared was 18. That's up sharply from just 6 at the start of the year and spiking a lot over the last couple of editions. The same time as when we've seen the dramatic increase in layoff announcements from data sources like Challenger, Gray, and Christmas. So here's an example from the Beige Book, the latest Beige Book from November, that mentions layoffs straight from the national summary. Quote, employment declined slightly over the current period, with around half of districts noting weaker labor demand. Despite an uptick in layoff announcements, more districts reported contacts, limiting headcounts using hiring freezes, there's no hiring, replacement-only hiring, and attrition than through layoffs. So you've got rising layoff announcements, weaker labor demand indicating fewer jobs overall. It actually fits with the data, unlike the tariff inflation story. The Beige Book itself is describing the transition to flat beverage, going from no hire, no fire to no hire and some fire. So Casey Jeff in October was simply moving the goalposts. All year, those like him on the Fed, which included Jay Powell up until August, kept saying the labor market was solid, which meant, at least the way they meant it, the labor market was growing, if at a slower rate. But now what Schmidt is doing is saying, well, it's no longer growing, but since the labor market isn't crashing, therefore it can't be all that bad. Let's focus on tariff inflation. And by the way, the stock market bought that idea for a time as well. What we keep seeing, however, is just more confirmation of the deterioration and degradation of the labor market and the overall economy. The transition to the flat beverage that is showing up in all these various ways. From the goalposts from Casey Jeff to the ADP reports, the multiple ADP reports, the multiple BLS reports, and even the Fed's Beige Book. So with all that in mind, no wonder the housing market is struggling with prices softening and even declining. Real estate, if you remember, was supposed to be picking up this year. Go back to last year. Everyone said with the Fed cutting rates, the housing market was primed for a rebound, maybe a recovery, maybe even better than that. And yes, everyone thinks the Fed controls rates, even though the Treasury market actually does. But either way, mortgage rates have come down, but housing has not come back. Start with Home Depot. We mentioned this before, the housing adjacent retail giant. In its last disappointing earnings report and forecast, the company's CEO just came out and admitted low rates were not working as they were expected. Quote, when we set guidance, we had anticipated that demand would begin to accelerate gradually in the back half of the year as interest rates and mortgage rates ease. But what we saw was the ongoing consumer uncertainty, there's that word again, and continued pressure in housing are disproportionately impacting home improvement demand. And of course, he throws in that word uncertainty because no one likes to say the consumer economy is weak and getting worse. Easier and friendly to talk about economic uncertainty than it is to have to admit job losses, and the prospects for a lot more of them are weighing on not just consumer sentiment, it's actually impacting consumer behavior. That's the point about Home Depot, and that's the point about the housing market. And I went over a prime example of that in another format in yesterday's video on Procter & Gamble and its battle with holiday shopping. Consumers aren't just saying they're pessimistic, they are actively pulling back. And like job losses, it's not crashing. It's not falling off a cliff. People aren't running for the bunkers. But it is happening, and it's happening around the margins, more frequently around the margins, and it's being sustained, and so it's showing up in more noticeable ways all the time. And of course, one of those ways, a big way, home prices, real estate, property. According to the latest data from the major sources that we have on home prices, whether it be S&P Case-Shiller or the FHFA's numbers, home prices at best stabilized after some downturn earlier in the year, but there's more indications, especially from the government's numbers, that the weakness is still, like the labor market, continuing on from the summer into the fall, heading toward the end of 2025. From the S&P Case-Shiller series, home prices, they, like I said, stabilized after dropping for the 4 months between February and July. But stabilizing in this case just means an absence of further contraction. And given how the job market worsened later in summer into autumn, that stabilization might be, dare I say, transitory. That's what the government's home price data indicates. According to FHFA's Purchase-Only Price Index, housing prices on average across the nation were down once again by a small amount in September, but the latest data the agency has put out shows after a noticeable rebound in August, the renewed drop in September makes 5 out of the last 6 negative months. And the 2 months before that stretch were basically zero. In other words, the government's home price data indicates an 8-month stretch of sizable and ongoing weakness that extends at least to the start of October. And because of that more recent downturn in prices, the year-over-year change for the index was just 1.6%. And while that doesn't sound too bad at first, this is the lowest annual rate of change for the U.S. national home price average going all the way back to February 2012. Yes, February 2012. That was back when real estate was just finally emerging from the epic housing bust. So again, like the 6-month average for ADP payrolls, the fact that an annual rate of change for national home prices is that low, equal to the bottom of the last bust, this shows you how serious it really has become in terms of housing because of what's going on in terms of jobs and incomes. But we also have some additional sources of stress and strain where it comes to housing that suggest not only that the condition in the housing market and real estate might actually be worse, as well as extending beyond the data that we have through the month of September. So let's go to Bloomberg here. When new home sales start selling at a discount to resale houses, it's time to sit up and pay attention. Apollo Global Management's chief economist Torsten Slok noted the anomaly in a recent note, the first time it's happened in more than 5 decades. The data on relative prices understate the dynamic because home builders have largely relied on mortgage rate buydowns to move property in recent years, an effective discount of several percentage points that isn't reflected in the nominal sales price, and so that we don't get them in these indexes. Existing home sales data, on the other hand, only tracks successful transactions, ignoring the growing numbers of disappointed would-be sellers that other places like Redfin are saying are continuing to stack up. Production developers, on average, spent 7.5% of sales prices on incentives in the 3 months ended August, according to John Burns Research and Consulting. They've given up the average premium of 16% that new builds have commanded since 1973, based on the firm's analysis of Census and National Association of Realtors data. Flattish existing home sales and pricing trends nationally, which we just went over, mask other data that show more significant deterioration in housing. Sales volumes have stayed at about 4 million for the past 3 years, even though resale inventory has risen significantly from the lows and is back to around 2019 levels nationally, albeit with a lot of regional variation. And that's another one which perfectly illustrates the underappreciated degree of weakness the housing market is suffering as a result of this flat beverage environment. Not trade wars, not tariff overreaction, not the stock market, flat beverage. The National Association of Realtors, or NAR, shows resale volumes that continue to scrape along the bottom, also despite lower mortgage rates and the perceptions of Fed rate cutting. That bottom is roughly equal to the lows from back in the last housing bust as well, going back to 2010, 2011, 2012. No one is buying houses. More houses are coming up for sale all the time, especially among Sunbelt developers, and prices are reflecting these simple economics. More selling, fewer buying, lower prices. And since we can't use the interest rate excuse any longer, not that some won't try, the fewer buying is immediately traceable to job shedding already and quite well-founded fears the labor market, like the housing market, is on track to get even worse. So with all this growing confirmation of flat beverage in literally everything from the property sector to the Fed's beige book, no wonder the markets are pricing a December rate cut, as I went over yesterday, in Treasury bills. The evidence is overwhelming that Casey Jeff was wrong to try to downplay the downside case for employment, or really unemployment, that appears to be picking up as 2025 draws to a close. There are consequences to all this too, not unlike what the Chinese have been experiencing for the past several years. Over there, the weak housing market and lower housing prices have hindered consumer spending, which worsened the economy and further depressed the property sector. Over back here, we have the prospect of more job losses that are holding back housing, which then leads to lower home prices and more reasons to cut back on spending, pointing to more job losses, therefore fewer home buyers and lower housing prices. And round we go. It can become a vicious cycle, a positive feedback loop where it only leads to negative outcomes in real estate as well as the real economy. Well, this macro housing bust is real, and it is really confirming the state of the job market, the job losses that we keep seeing. So whether the Fed cuts next week is really immaterial. As it turns out, real estate, like the real economy, are both stuffed to the rim with Pringles. And you add all of that together with what Procter & Gamble, an important company because of its position, its unique position in the real economy, what Procter & Gamble said, and you get what's in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.